Hello and welcome everyone to Grow Money Talk. Today we have with us Mr. Chintan Haria. He heads the product development and strategy at ICICI Prudential Mutual Fund. Last time we discussed about liquid funds and smart safe with Chintan, and today we will be discussing the correct asset allocation between equity and debt. During the session, Chintan will be answering your questions about investing. So stay tuned and leave your questions in the comment section. Welcome, Chintan. It's good to have you again at the show. Over to you.
Thank you, and hello to all the users of the Groww app. Thank you for the introduction. And first, I'll just like to cover the markets over the next 1 or 2 minutes because that basically is something which interests all of you to warm up, and then we'll move on to the main core subject, which is of asset allocation and its importance. On the markets, of course, and the markets the way they are actually are a very good learning ground for us to know the importance of asset allocation. If we see over the last 5 years what has happened, courtesy the stronger government in 2014 and the global positivity that was there, we saw markets rising between 2014-15. Then the China problems meant that in 2015 we saw markets correcting. Again, 2016, because of the monetary reflation in China, the markets went up. Along with that, Indian markets went up. And post demonetization in 2017, we saw a significant rally in the Indian markets, taking valuations to extremes in the mid and small cap space. Courtesy the extreme valuations in the mid and small cap space in 2017, 2018 and 19 have been softer. We've seen correction. We've seen valuations becoming a bit more reasonable. And that again provides an opportunity for us to enter. Now, from a perspective of where we see markets or how should we look at markets, markets are a reflection of what we see in the economy. Today, we are a $2 trillion economy or a $2.7 trillion economy, likely to move towards $5 trillion over the next 4 to 5, maybe 6 years. And if we see, along with market capitalization, along with the market, the GDP growth, the market capitalization also tends to grow. And that's the opportunity for equity investors to participate in the market. Historically, of course, Indian savings haven't been significantly invested in equities, but thanks to the acceptance of mutual funds as a way of investing, people have started increasing their allocations towards equity and equity-related products. Now, if we see on the fixed income side, fixed income also has seen its own ups and downs. Till about end of 2018, things seemed okay. Then from September, October 2018, once the NBFC crisis has panned out, the so-called liquidity has dried up, and that has probably taken the corporate bond spreads much higher. So while the G-Secs, which is the government bonds, are actually falling in terms of interest rates in line with what's happening in the globe, the space of credit risk, as it is called, or the accrual category, is actually seeing the spreads which are probably the highest that we've seen in the last 5 to 7 years. So that provides an opportunity from an investment perspective. So there are pockets of relative valuation which are cheap within equities. There are pockets of relative valuation which are cheap within debt. So what does all of this mean, and how do you as an investor, or how do you as a person who is working hard or who has his own business, who has his own salary or job and is saving, how would you know where to invest, when to invest, how to invest, and more importantly, how much? That's where the asset allocation part of it comes into play. Because as normal investors who are not seeing markets day to day, it is almost impossible to get the right asset allocation mix. And it is only asset allocation which can create long-term wealth. Because, for example, in 2017, when equities were the favorite asset class for most investors because equities were giving good returns, if you ended up investing all your money in equities, you would have probably had a bad experience in 2018-19. Similarly, if you put all your money in debt in 2016 and 2017, the markets rallied, you wouldn't have made that kind of an impact in terms of your wealth creation. So what is the solution to this problem of how to allocate, where to allocate, when to allocate, and most importantly, how much to allocate in each of the asset classes that are available? That essentially, my friends, is asset allocation. And that's where the asset allocator funds or the dynamic asset allocation funds come into the picture. I'll obviously be speaking about the asset allocator fund in detail later. But essentially, from your perspective, it becomes very important to know that while many of you think that I invest in different schemes, I invest in different market capitalizations. I have spread out my investments, I'm spreading it out over time. That itself is good enough for long-term wealth creation. I'd say in which asset class, at what point of time, and how much do you invest makes the bigger difference. And that's where you need professional expertise. Because based on valuation, if you have to be in an asset class which is cheap, that is something which you may not be able to know because you may not know the parameters, and it's probably something which requires a little bit more of in-depth knowledge of the economy and the valuations of the markets. It's a specialized job after all. So that's where the ICICI Prudential Asset Allocator Fund comes into the picture. What the ICICI Prudential Asset Allocator Fund essentially does, or what do asset allocation funds in general essentially do for you, is based on market valuations, it will move between equity and debt. If we see over, if you see in the asset allocation funds, you need to be in the right asset class at the right time. I'll give a case in point. Returns of different asset classes at different points of time over the last one decade. It is something which is there in terms of, if you can see the graph in front of you. We've basically jotted down 2010 to 2018, the returns of equity, which is the benchmark index, and the GSEC is the returns of debt. I may want to highlight 2010 to you. Equity markets gave 19% return, while debt markets gave 3% return. You would say I would have been better off in equity markets. So then you invest in equity markets, all your money in 2010. And then what happens in 2011? In 2011, if you have invested all your money in equities, you are minus 24 in 2011, while GSECs are still steady at 2%. Then in 2012, you get worried with the fact that 2011 was a negative year and you take out all your money because that's what most of us typically do. If markets come down, we basically take out money instead of increasing our allocation. And equity markets in 2012 gave 29% return. So essentially what I'm trying to highlight, my friends, and you can see it in front of you, that every year, because equity is a more volatile asset class. And why is equity a more volatile asset class? Because it is basically combination of all of us investing in the markets, macro factors, FIIs, that is the foreign investors, liquidity factors. It basically is more volatile than the debt markets. Equities tend to move up and down much more. They tend to move ahead. It's like, think of a pendulum. It moves on one end because of the bullishness that all of us have, and it moves on the other end because of the bearishness that all of us have in terms of markets. And it's a herd mentality in terms of, if everyone thinks life is bullish and they invest money in equity markets, when equity markets are overvalued, you tend to basically make losses. While on the other hand, very similar to right now, when economy is not probably in the best of shape, you're hearing all the bad news and you're hearing all the problems with all the companies, and the earnings are not growing and the markets are falling down because FI selling of 14,000 odd crores has happened in July. You end up basically taking out money while actually you should be putting in money. And that is where, my friends, asset allocator fund becomes an extremely important tool in your hand. Because in very simple terms, what an asset allocator fund is going to do, in times like these when markets have, for example, corrected 6% in July, it will actually increase your allocation, for example, from 26% invested level to 36% invested level, because relatively markets have become cheaper. Now, you and I doing it individually may not be the easiest, and I'll come to it when we do the question and answer session with Vijay. So over to you, Vijay, and probably let's take up the question and answers.
Thank you, Chintan, for briefly taking our audience through the concept of asset allocation. We actually have some very specific questions. So as you mentioned about the asset allocation. So why can't a retail investor do the asset allocation on their own?
Yeah, that's a good question, and all of us feel that, okay, I can do my asset allocation on my own. It's very simple. I put 50% in equity, 50% in debt, and I should be fine in the long run. Yes, my friends, if you do that, you will be fine, but you will probably want to do better, or your wealth creation can be better if you can actually move from 100 to 100. In other words, 0% equity to 100% equity in a systematic manner on a daily rebalancing basis or a monthly rebalancing basis, as most asset allocation funds do. In simple terms, if you and I as retail investors start doing it, it will first of all take away time from our day-to-day activity. It may hamper our day-to-day activity. Secondly, on a taxation and transaction cost front, it may probably not be very frugal, because if you say equity taxation in the long run, on the long-term basis or on a short-term basis, you may have to incur certain taxes. On the debt side also, if you don't keep it for 3 years, you'll need to pay certain taxes, or if you don't keep it for 12 months, if it's a listed bond, you'll have to pay certain taxes. So essentially, to avoid leakage of tax, to make it very convenient for you, it is basically easier for you to do it through a asset allocator fund. Also, the fact that, of course, on what basis would you be able to actually predict whether 25,000 Sensex is cheap or 35,000 Sensex is cheap? Because Nifty, when it went to 9,000 in March 2015, was probably expensive because in March 2015, based on the earnings of Nifty at that point of time, it may have overshot it at that point of time. If today, for example, after 4 years of Nifty earnings growth or expected earnings growth over the next 2 years, markets come down to 9,000. 9,000 in March, 9,000 Nifty in March 2015 is not the same as 9,000 Nifty today. And hence, from your perspective, you do not necessarily have the tools to figure out what is expensive, what is cheap. We, on the other hand, obviously know we have basically an equity valuation index. We see the relative play between interest rates and valuations on a PE, PB terms, market cap to GDP terms, all of it put together, and we will come to know, okay, what is the right fit in terms of equity, and we can do it for you on the monthly or on daily basis as the case may be, and that provides that added edge or added alpha to your overall long-term wealth creation. And hence, we say this is a product, asset allocator fund as such, which should be a core part of your core portfolio for long periods of time, minimum 3 years, but it can actually be kept forever.
Also, Chintan, we have seen that a lot of our users, they have invested money in small cap, mid cap, multi cap kind of funds. Isn't this the asset allocation, or is it entirely different concept that we are talking about today?
Yeah, so like I said, and it's also a very deep and good question. If we see, we may put in mid cap, small cap, large cap. That's within an asset class of equities you are allocating between different market capitalizations. When you invest in 2017 December, for example, you may invest in large cap, which may be Nifty. You may invest in mid cap and small cap also. And what if markets in 2018 itself fall? You will not have safety of being in debt at that point of time. So, my friends, within an asset class, if you keep playing, you are bound to basically have suboptimal returns because no matter what happens, an asset class goes through its cycles. Typically, we say equity has 8 year cycle, something like debt has probably 3 to 5 year cycle, gold has a longer cycle of 10 to 12 years, and real estate has a 15 to 18 year cycle. So, if you get caught on the wrong side of the cycle, no matter how good your stock picking is, no matter how good your timing is, you are probably going to get hurt because the markets itself will kind of take away the gain that have. So what happens is 3 to 4 years of good term in equities, and then you'll have a bad year, and that's where you can get hurt. So diversification is not asset allocation. Asset allocation is essentially moving or keeping money in different asset classes in a proportion, at the right time, in the right place, and in the right proportion, which will help you grow wealth by, most importantly, not seeing destruction of wealth in an overvalued asset class. So when you're doing asset allocation, you're buying or putting more money in a cheaper asset class. Equities in 2013, equities in 2008, 9, say equities now, your equity will increase as the markets keep coming down. So when you are invested in a cheap asset class, the chances of your wealth growing is higher, and you will avoid the expensive asset class. So when you don't invest in an expensive asset class, you don't see the fall in your wealth. Combination of these two means that in the long run, your average wealth creation will be higher than those who don't practice asset allocation.
Also, having said that, there are a lot of users on our platform who invest through the SIP route. And the average ticket size comes roughly about, say, like anywhere between 1,000 to 5,000 rupees. Is this asset allocation really important for retail investors, or is it only meant for the people who invest probably in lakhs?
No, so in fact, it is probably more prevalent for those who invest in 1,000 or 5,000 or a small ticket size because it is essentially the middle class or those who are saving with very great difficulty and investing who cannot afford to lose their capital. A person who's probably earning in lakhs and can invest in lump sum big amount may have the ability to also withstand temporary losses in the market. But someone who is probably capturing that 1,000, 5,000 part may not want to necessarily lose capital in a big way, and that's where asset allocation fund becomes very important for them. So the amount does not matter; it's the consistency with which we invest. And you spoke of SIP. Just numerically, if we see, if you invest 10,000 rupees for 20 years and if you get a return of 12% over the next 20 years, then generally on a 20-year basis, that comes to rupees 1 crore. So if you believe that you want to generate a corpus of 1 crore after 20 years, a simple investment of 10,000 rupees, which generates say 12% over 20 years, can do that for you. Whether the 12% comes, doesn't come, of course, it is all dependent on the market, and we cannot predict what the market will give. But each investment, every drop makes an ocean. So everything that you save, your saving is effectively your future earning, and what you save, if you invest in the right asset like the asset allocator fund, it will help protect downside, participate upside, your wealth creation will take place. Most importantly, we forget risk as an element when we invest, and this product takes care of the risk part of it, which cannot be taught. It's not easy, and none of us learn it while we are actually in school also. But it's easy to make money by taking more risk, but that's not how you make money, because you end up basically destroying value also. Asset allocator fund on a risk adjusted basis endeavors to grow your wealth over a long period of time. And that's where, my friends, I believe that even a 1,000 rupee investment, even a 5,000 rupee investment, the money does not matter. It is essentially what you do, what you save, and how long you can keep in the asset allocator fund that will determine your wealth creation at the end.
Also, Chintan, we have seen that a lot of our investors and users, even during this video, are questioning about that where should I invest my lump sum coppers? Because everyone is talking about the SIP investment. That okay, if you have say like 5,000 rupee to invest every month, you can choose probably different set of funds. But what if I have say like a lakh rupee to invest in lump sum? What kind of a fund I should look into?
So, like it is said that if you are being advised well, if you yourself are wise, you read economics, you read probably enough books on investing, you can do it yourself. But most of us, of course, are not equipped for that. If you are advised well, then that advisor can actually advise you for equity funds, debt funds, pick and choose type, it can be a la carte. But if you're not advised, if you're not capable of doing it yourself, because obviously you don't have the time, you may be busy with your own business or your own job, then the asset allocator fund is a great tool in your hand to basically invest lump sum, because you don't have to worry whether equity markets are cheap or equity markets are expensive. Within that, you should not worry whether I should be investing in mid cap, small cap, large cap, because essentially what we try to optimize, or what we may try to optimize in this fund, is your investment in equity based on the current equity valuation and its relative valuation with debt markets as well. And in general, what you will get the advantage is probably best of both worlds, equity and debt in the long run. Uh, it will be better than having a constant allocation, because of the fact that when you have the maneuvering capability of 0% equity on markets are expensive and 100% equity on markets are cheap, you're actually getting the best of the equity markets, and then debt plays a stabilizing role when equity markets are expensive. So you don't have to worry about where to put your money. If you put it in asset allocator fund, we are basically taking the responsibility of being in the right asset class, which is equity or debt, in the right proportion. And within the asset class also, if we pick the right fund, it will actually do the job of creating wealth for you in the long run.
Also, Chintan, we have seen that a lot of our users want to understand that how one fund of ICICI, which is asset allocator fund, how is it different from something like a dynamic asset allocation? And does this fund also invest in gold as an asset class, or will it actually invest in gold as an asset class?
Perfect. So dynamic asset allocation is a category. Within the dynamic asset allocation, many different types of formulas are possible for running the underlying funds in terms of the dynamic asset allocation category. Our equity asset allocator fund, or the asset allocator fund of ours, is essentially built on a simple principle that when equity markets are cheap, you have more equity. When equity markets are expensive, you have less equity. It is a fund of fund with debt taxation. So in the long run, if you actually see, if you keep it for more than 3 years, you get the advantage of indexation also, and a 20% tax on it post indexation capital gains. And comparing it with other asset allocation funds, ultimately the destination is the same, the routes can be different. And our route is very simple. The advantage over here is 0 to 100% equity you get. And that actually fits very well from an investor perspective, because you're actually getting the entire breadth of 0 to 100 when you are investing in asset allocation.
Also, we would like to know that as you mentioned about the asset allocation, so what should be the frequency that one should keep on reviewing the their own investments? Because everybody keeps on talking about the long-term horizon, but do we really need to say like wait for 3 years and do the review, or is it like there is a frequency that one should really worry about?
So effectively, once in a year, we file our income tax returns. So generally, it is said that when you're filing your income tax returns, you actually get your house in order in terms of all your balance sheets and income statements and all your investments, etc. That may be a good frequency as well for you to review your investments. So if you have various investments in various funds and etc., that's a good frequency with which you can look at it. Of course, there are elements like 3-year taxation in the case of debt and all, which you need to keep in mind. But from an allocation perspective, 1-year review is good enough. You don't need to probably spend time every month in doing it because it's probably not adding too much value. And if we see in terms of if you invested all your money in asset allocator fund, then it is automatically happening probably on a monthly basis or a daily basis in the dynamic asset allocation category funds in any case. So every year when you'll actually see it, it will automatically be adjusted based on the expectation of market value or based on the market valuations and the expectations of future which asset class will do well of the asset manager who is managing that asset allocation fund for you. So 1 year is a good number. Once in a year is a good number from a perspective of reviewing your asset allocation.
While you were actually explaining about these concepts, there are a lot of users who have been putting a lot of questions. One of the user, Mr. Rohan, he has posted a very interesting question that how to identify what is the right time for an asset allocator. And also, we have seen that the theme of ICICI Prudential Asset Allocator Fund is all about right time in right proportion. What does this really mean?
Yeah, so it's basically the genesis or the core of what the product is all about. Uh, Knowing the right time to invest, we may come to know in terms of where to invest, we may come to know, but how much becomes the challenging question at all points of time, right? You can get the market bottom perfectly right, like in 2013 or 2008 October, and invest only a fraction of your wealth and feel happy that your fraction of wealth has doubled. That doesn't help in the long run, and that's where an asset allocator fund comes into the picture or an asset allocation comes into the picture. What it essentially means is that asset allocator fund will ensure that what you invest in the right proportion goes into equity. It's not just 2% of your overall corpus you put it in equities, it doubles and you feel happy about it because that's where all of us tend to get satisfied. And Rohan, if we actually see, that's what we are trying to plug with the ICICI Prudential Asset Allocator Fund. What we essentially do, just to explain the process through which the fund is basically run. When you give us the money, you are not aware of the market valuations. We are aware of the market valuations. When you give us the money, you may not necessarily know how much to put in equity, how much to put in debt, but we definitely try to, through models and through our own simulation, figure out where is the market relative to interest rates, relative to price to earnings, price to book, etc. and allocate a certain part of your money. So suppose you've given us 100 rupees. Today roughly about 33 or 34 rupees will go to equities and the balance 64 rupees will go to debt. How will it go? That 33 or 34 rupees will go into an underlying fund which we have chosen. In this case right now it's the large and mid cap fund. And the balance 63% will be into debt schemes, which again can be either accrual schemes or the gilt schemes or the government bond schemes as the case may be and can change from time to time. So effectively what I'm trying to say is you are getting exposure to the right asset class at the right time and most importantly in the right proportion, because the mistakes which most of us make is that we are not able to invest in a big way. It's like for all those of you who have played card games, all in terms of going all in when the markets are cheap. You're not able to do that, and that's where we don't create wealth. The biggest wealth is created when you bet big on an asset class which is very cheap. And through human psychology, it's almost impossible to bet on a market which is down, and that's when the maximum return comes in market. We try to plug that gap, plug that emotional shortcoming that we have. All human beings have it. Even I've seen it. Even sometimes fund managers also get frustrated with markets which are falling. We try to plug that through asset allocator because asset allocator fund is not based on only our gut feel. It is based on the model which tells us that today relative to interest rates, equity markets are cheap and hence you should be investing X percentage in equities. In the long run, this smart allocation between equity and debt is what creates wealth for you in the long run. The presentation in its own right details all of what I have said, and it is probably something which I urge all of you to also see. Thank you.
Last couple of questions, Chintan. One of our user wants to know that how much it goes in equity and how much it goes in debt, and how the taxation also plays a role over here.
Yeah, so you probably one thing which I missed is on the gold part of it also. So this fund essentially right now as we speak, given that interest rates in India are still at 8-9% for certain corporate bonds, etc., and the yields are still high, it is currently positioned to move between equity and debt. 0% equity to 100% equity, 0% debt to 100% debt. Like I said, roughly about 33-34% in equity right now, the balance in debt. It has a provision to go up to 50% in gold as well at a time when probably debt as an asset class probably is not looking that attractive. Equities have probably run up a lot. Gold becomes a good asset class, and so we're giving that opportunity to the fund manager as well. That at an opportune time you may end up taking gold. As of now, there is no gold in the fund. The allocation is allowed, but we believe that right now equity plus debt is something which can give on a combination a good return from an investor perspective.
And my last question for the evening is that how is it different from a normal balanced fund? Because I see a lot of our users are putting questions regarding balanced fund, balanced advantage fund, the dynamic asset allocation, and obviously this multi-asset fund.
Yeah, so before I go on to the comparison with the hybrid category or the aggressive hybrid category as it is called, the balance category is now called the aggressive hybrid category. I'd probably touch up on the question on taxation which you mentioned, which I did not answer in the last question. From a taxation perspective, the asset allocator fund is a fund of fund investing in underlying funds. So essentially, from a perspective of an investor, if you've invested in an asset allocator fund and you remain invested for more than 3 years, you are eligible for indexation benefit, and on the indexed cost, whatever is your capital gain, you get taxed at 20%. So that's basically the taxation aspect of asset allocator fund. If you do not redeem and you continue, there is obviously no taxation element till the time you redeem. So you can continue your investment for 3 years, 5 years, 7 years, 8 years, 9 years, 10 years. And the underlying investment changes which happen, they do not have a taxation impact on you. It being a fund of fund and the structure being a fund of fund. So that's on the taxation part. And the last question was?
So it was also about that a lot of users are.
Yeah, the balance category and the comparison with the balance category. So yes, if we see what the aggressive hybrid or the balance category is, it is generally 65 to 70% invested at all points of time in equity. So the aggressive hybrid category or the balance category, it is as it is more commonly known. It is essentially a category wherein if you put money, 65 to 75%, let's say 70% for simplicity sake, at all points of time will be in equity, the balance 30% will be in debt. So there is no element of moving between equity and debt based on valuation in a balanced fund. So what you get at all points of time is a constant allocation to equities. That's the aggressive hybrid category. India being a growth market, all those who have invested in the balance category and have stayed invested for years have got a good experience because equity markets have delivered good returns in the long run. And debt markets also obviously returns have been up to upwards of 7 or 8% in most market cycles. So as a combination, the balance category has generated good returns over the long run. So it may also continue to do so over the next 10 years, 15 years. So those who are looking for constant allocation of say 65 to 70% in equities, the balance category comes into play or the aggressive hybrid category. But this fund, for example, the asset allocator for any dynamic asset allocation fund, moves dynamically, say 0 to 100 or 30 to 80 between equity and debt. So it's more an asset allocation tool, which in rising markets may probably underperform the balance category because you may be invested less than 70%. But when the markets fall, because it may be as low as 10 or 20%, it can protect downside. So net net, if you see in the balance category, if you invest at market tops, for example, if you invested in a balanced category fund in 2017 and you invested in say an asset allocator in 2017, there are chances that if markets fall 30-40%, because you have 70% equity consistently in the balance category, the downside which a balance category fund can see may be higher than an asset allocated category. At the same time, the reverse is true. If the markets go up, your upside can be higher in a balance category compared to the asset allocation category. However, in the long run, it evens out. So in the long run, our belief is that the end result may be the same. It's just that the volatility in the balance fund will be a lot more. And if you as an investor come at the top of the market in a balance category fund, see your AUM come down by 10, 15, 20, or your returns come down by 15, 20%, and your invested capital comes down to say from 100 to 80, you may panic and take out the money. That is unlikely to happen in an asset allocator fund because the asset allocator fund in peak markets will be less equity, so you will not see the fall in your asset allocator fund NAV to the extent of the balance category. So it's a trade-off, like I said, but from people who probably don't understand these nuances that much, I'd say investing in an asset allocator fund will give you a good risk-adjusted experience without giving you shocks when the markets fall and participating enough in the market rises so that you are happy and you sleep peacefully and you live a happy life. Thank you.
Well, thank you so much, Chintan. I think that was quite a good explanation to our users who did not have too much of understanding on this particular topic. Thank you so much for your time. And thank you everyone for attending the session. We hope you liked it. Please like and share this video. We'll be back soon with such more videos. Thank you so much.
Thank you.